How to trade the turtle strategy. A full guide to beating. Day and swing traders. Your cursor shakes over the entry line on TradingView. The 20-day high just printed. Candlestick stair-step along a rising 50 EMA. ATRs expanded. Your alert pings again. Donchian 20 breakout confirmed. The chat is screaming sell because it's too extended, but your stop loss is already plotted at 2N below. Your position size is pre-computed, and the rule says, take the entry. One click and you'll be long, not because you feel bullish, but because your system fires. Your thumb hovers. You can almost taste the dopamine hit from green P&L as price ticks your way, and you can almost feel the cortisol if the first bar snaps back and paints a fat red candle. This is the moment the turtle strategy wins or loses before any position is even opened. It wins when you obey simple mechanics in a noisy market that punishes hesitation and rewards discipline. It loses when you let the amygdala manage your risk. Most traders lose money. Past patterns don't guarantee the future. Not financial advice. But if you want a full guide to actually trading the turtle rules entries, exits, sizing, pyramids, while beating the day traders clicking market orders and the swing traders massaging narratives, it starts with rewiring your mind to think in probabilities, execute like a machine and survive the drawdown without touching that stop. The turtle strategy is painfully simple. Buy strength that breaks out, sell weakness that breaks down, size by volatility, and cut fast when the move fails. It is also painfully hard because the human brain is optimized for stories, not distributions. You'll face entry hesitation paralysis at the exact moment the breakout triggers. You'll feel exit greed when a trend runs and your mind whispers, move the stop loss down just a little more, keep it open. You'll be tempted by stop loss removal syndrome, the first time a deep retrace almost tags your level and you think, it's just noise. You'll hear the revenge trading loop tempting you after 3 whipsaws. Double the size and get it back. When you follow a mechanical trend system, whipsaws are tuition small, repetitive paper cuts that your impatient brain codes as failure. The day traders scalping level 2 will look like geniuses on chop days, and your mirror neurons will nudge you to copy their quick flips. You'll add more screens, more oscillators, more confirmation, and paradoxically get less clarity. Tighter stops feel safer, but for a volatility-sized system, they can amplify losses by forcing multiple re-entries at the worst possible time. Welcome to the turtle paradoxes. Perfect setups fail often, the best trades feel uncomfortable at the entry, and more analysis can lead to worse results because discretion contaminates expectancy. Here's the clean skeleton of the rules you'll actually trade. 2 core breakouts. System 1 enters on a 20-day Donchian channel breakout and exits on a 10-day counter breakout. System 2 enters on a 55-day breakout and exits on a 20-day counter breakout. You compute N, the exponential ATR proxy for volatility. Risk per unit is capped. Each initial position risks 1% and 2% of equity using a stop 2N away. You can pyramid up to 4 units as price moves in your favor by 0.5N increments, each new unit risking the same per trade percentage with its own 2N stop. You limit correlation. No stacking the same theme across pairs or highly correlated tickers. You never move the stop against the position. You never skip a valid breakout because it looks overbought. You never add size after a loss to make it back. That's it. The elegance is brutal. In a trend regime, you'll let winners compound. In ranges, you'll pay a daily subscription fee in small losses. Risk management is survival. If you can't take the small losses, you won't be around for the large wins. That's not philosophy. It's the plumbing of P&L. What makes traders fail with turtles isn't the math. Any spreadsheet can compute N. It's the biology. Green flashes of unrealized profit trigger a dopamine surge that keeps you glued to the 1-minute candles, nudging you to take quick partials that decapitate the system's positive skew. Red heat in a drawdown spikes cortisol and narrows attentional bandwidth. You stop scanning the portfolio-level risk and tunnel into the current candle, exactly when you need to zoom out to the regime, the distribution, the sample size. Volatility days bring an adrenaline spike. You'll feel invincible when you catch a breakout early, then overtrade the next 5 signals. Serial losses deplete serotonin. Your mood dips, confidence drains, you start second-guessing rules that were fine yesterday. And in social spaces, Mirror neurons amplify crowd conviction. You'll see 100 charts calling this breakout exhaustion, and you'll flinch. None of that goes away with more indicators. Your brain isn't broken. It's designed for survival in uncertain environments by overweighting threats, anchoring to recent pain, and copying the tribe. The turtle playbook wins precisely because it neuters those circuits with mechanical rules. Let's face the three costly patterns most turtle traders bend the knee to. First, averaging down disasters. You get a 20-day breakout short on a crypto pair, it rips back above the channel, and you add just one more because it'll roll over. That's a hidden belief conflict. You want to be right more than you want to be profitable. The rules assume random outcomes. You assume your read is special. Second, FOMO market orders. You miss the first breakout candle and jump 3 ATRs above the channel on a spike, converting a defined 2N risk into a lottery ticket with no edge. Third, moving stop losses. You plan 2N, then compress to 1N after 2 small losses to protect capital, guaranteeing more whipsaws, more entries, more commissions, and a broken expectancy curve. Each of these errors has a simple signature in your journal. Risk per unit creeps higher when you feel behind. Stop distance shrinks when you feel scared. Entries appear outside predefined breakouts when the market looks like it's leaving the station. If you aren't tracking those deltas, you aren't running a system, you're skating on mood. Meet Marcus, today's archetype, the system trader. He doesn't pretend to predict. He runs a portfolio of liquid futures, FX majors, and large cap stocks on daily timeframes, with intraday alerts for day trading only when the system's rules compress from D1 to H1 in event-driven sessions. His desk is monastic. 3 monitors, trading view for charts, an execution platform with OCO brackets, a volatility dashboard with N across symbols, and a risk panel pegged to equity. Pre-market, Marcus updates N, equity, and unit size, scans 20-day and 55-day channels, tags correlated names, and loads conditional orders at the breakout levels with stops at 2N. If he's flat, he's preparing. If he's in positions, he's checking whether price has advanced by 0.5N to add a unit. He doesn't manage entries, he manages exposure. When the first unit goes green by 0.5N, he adds the second. When price retraces 1N, he does nothing. When price collapses 2N from his last add, he's out of the entire position by rule, not by gut. He never looks at RSI to feel better. He glances at level 2 only to avoid slippage during news. Volume profile? Useful for context, not for vetoing the system. His edge is not a line, it's the law of large numbers applied to clean breakouts with asymmetry. Marcus knows drawdowns come in clusters. He sizes so that 5 to 7 small losses feel like tiny pebbles, not boulders on the chest. He's fluent in the trading paradox. The best entries often feel awful because a breakout looks the most extended exactly when it's valid. He breathes through that discomfort, like a marathoner accepts fatigue. Marcus's day shows how this plays in real time. USD posts a 55-day breakout. The alert fires during London. His conditional stops and takes are already staged. He gets filled at the channel high. ATR-based 2N stop is below the recent consolidation. He adds at plus 0.5N, again at plus 1.0N, again at plus 1.5N, each time risking the same percent. Twitter calls it a blow-off. A popular swing trader shorts the double top. Marcus doesn't care. He's not trying to beat the day trader in speed or the swing trader in story. He's beating them by not leaving the room when the trend actually starts. On another symbol, a 20-day breakout fails in 2 hours. He exits, logs valid loss, flips the chart to a watch list for the next signal, and doesn't try to earn it back on a lower timeframe revenge scalp. His journal template captures the setup label, 20D or 55D, entry level, N stop, units added, whether he felt entry hesitation, whether he Googled for confirmation, chart pattern hallucination, and whether he violated any rule. He uses a cooling off rule. After 3 system losses in a day, no discretionary trades allowed. That rule exists because the brain after loss wants action, not quality. Risk defines the trade, he mutters, stealing it from his wall. How do you rewire yourself to trade turtles cleanly? Start by building your environment to force the right actions. Put your unit size sheet on your screen. If equity is $100,000 and you risk 1% per unit with a 2N stop, and N is 1.2%, your dollar risk per unit is $1,000, your stop distance is 2.4%, and your share size is position value. 2.4% and $1,000, roughly 41,660 in notional on that symbol. Translate to shares contracts exactly, no rounding by feel. Pre-stage conditional stop orders at entry, never manual. Use OCO brackets so the stop loads with each ad. Lock your platform to block order submissions that exceed your per unit risk. On TradingView, code an alert that fires only when the channel breaks on closing prices. Shadow break intrabar is noise you've agreed to ignore. Journal like a scientist. For each trade, tag one of 6 behavioral biases you felt. Entry, hesitation. Exit, greed. Stop, removal impulse. Revenge urge, overtrading compulsion, or pattern hallucination. Then write the sentence you told yourself. That captures the belief behind the error. Replace it with a rule-based sentence. This entry is one breath, not the whole trade. Create a daily scoreboard that gives you points for process, not P&L. +1 for taking every valid signal, +1 for never moving a stop, +1 for never adding outside 0.5N increments, +1 for correlation discipline. You can finish down money and still win the day. That matters because risk management is survival. Next, tackle the chemistry. Before the open, box breathe for 3 minutes to lower baseline arousal. The goal isn't zen, it's bandwidth. During high volatility sessions, use a 90-second cooling off micro break after any stop out. Stand up, look at a distant object, and reset your gaze. This interrupts the reflex to click the next candle. After a series of wins, deliberately reduce position size by 25% for the next valid signal. This is a friction pad against adrenaline-driven overconfidence. After a series of losses, do not shrink stops or skip signals. Do the opposite paradoxical ritual. Read your log of past streaks and the subsequent payoffs that only arrived because you stayed engaged. Set a mirror neuron trap, a separate workspace with no social feeds during the first 90 minutes. Your friends will still be wrong at lunch. Then install the beliefs that make the rules livable. The market does not pay you for being right. It pays for aligning with flows long enough to let asymmetry express. Probability thinking's not optimism or pessimism. It's indifference to a single outcome. Your system is a process for harvesting outliers, which means your distribution of returns is lumpy by design. If you're trying to smooth it with feel, you're sabotaging the very edge you're renting. Past patterns don't guarantee the future. They only define valid until they don't. Most traders lose money is not an insult. It's a map of human wiring. You are not special. That's good news. You don't have to be. The way to trade is to codify a behavior that survives your worst day. The disciplined trader in you accepts that every belief you learn outside markets seek comfort, avoid pain, pursue certainty, will injure you at the order ticket. Trading in the zone is not a vibe. It's the state that emerges when your rules remove the need to decide. The psychology of trading expands that state through deliberate practice. Rehearse the what-ifs that used to trap you. Trading Psychology 2.0 upgrades your process when regimes change. Keep your system, adapt your universe, adjust and risk if volatility regimes explode. And the market wizard's lesson is simple. Edge is perishable, but discipline composes. Let's walk a full trade with the rewired process. You've scanned APL breaks a 55-day channel on strong breadth across megacaps. N is 2.1. You set a stop at 4.2% below entry, risking exactly 1% equity for the first unit. The moment price closes above the channel, you're in with an OCO. Price hesitates. Chat screams fake out. You log entry felt uncomfortable, tag the bias and write best trades feel uncomfortable. Price advances 0.5N. You add the second unit with its own OCO. Stops for all units now trailed only by the rule that all exit on a 20-day counter breakout or a 2N drop from the most recent ad whichever hits first depending on your strict version. A new spike chops the chart. Your unrealized P&L swings. You do not touch the stop. The third ad triggers at +1.0N. 2 days later, a deep retrace carves a scary red candle down 1.7N intraday. Your chatterbrain requests mercy. Your rules give none. You walk away for 90 seconds. The daily close holds above your 20-day exit, so you hold. On day 5, the fourth ad fires at +1.5N. You are now running 4 units, still risking the same percentage per unit, thanks to the pyramiding math. A week later, a 20-day counter breakout tags exit all. Do not negotiate with the rule. You capture a multi-N run with stacked exposure and your equity jumps in a step, not a slope. You journal, valid exit, no intervention, rule obeyed. Then you ask the only question that matters. Did I follow my process? Not, did I catch the top? Day and swing traders tried to outthink the trend, striving to time every minor pullback, to nail perfect entries on 5-minute RSI divergences, to be praised by comments for selling the top. Many of them made money intraday while you bled small losses. Many gave it back when the macro move extended beyond their frame. You beat them, not by being smarter, but by being structurally different. Your beliefs were aligned with randomness, your stops respected volatility. Your position sizing treated risk as a unit, not a feeling. Your pyramids harvested the right tail. Your brain chemistry was managed, not denied. Your screen time was focused, not frantic. More screens became less clarity for them. For you, less decision became more edge. Picture the transformation. Your platform no longer feels like a casino, it feels like a cockpit. Breakout alerts are binary, they fire or they don't. Entries are one breath, not a verdict on your worth. Stop losses are part of the sculpture, not vandalism. You accept drawdowns as the membership fee that keeps you in the room for the big waves. You talk less about winners and more about rule adherence rate. You expect whipsaws and treat them as unit tests of your discipline. You are calm in volatility because your position sizing assumes it. You follow stops because you define risk before you enter. You let winners run because your exit logic is written before the first tick. You aren't competing with day traders for ticks or with swing traders for narratives. You're playing a different game with a different scoreboard. Past patterns don't guarantee future results. Most traders lose money. But the turtle strategy, traded with mechanical integrity and psychological immunity, gives you something rare in markets. A repeatable way to be in the trades that matter and out of the ones that don't. That's how you beat them, not with opinions but with process.